So let's say that we don't go into cost segregation. What are some of the other things that people can do to help them in terms of taxes? Maybe like if a vehicle is over 6,000 pounds, maybe what else are people doing, or what else can help different business owners? Um, yeah, to help them.
Yeah, so for most of our business owners, and again, specifically for our real estate folks that are doing the fix and flip development, wholesaling side of things, who have active income or said differently, earned income, then the vehicle deduction is a powerful one. But I have a little bit of a rant that I usually go on. I'll condense it for the show here. I like the vehicle deduction. I like, a lot of people use that as a flex, especially when we're talking about business credit and different things like that. That all makes sense. But I caution you to understand the implications that come along with it. Number one, if you're going to write the whole thing off, 100% of that vehicle needs to be used for business purposes. The moment you have any of the personal use attached to it, you've now overstated your deduction and kind of exposed yourself. So as long as it has 100% business use, then let's do it. Let's go for it. If you qualify, let's get it done. It's a great tax deduction for vehicles that are over 6,000 pounds, i.e. a G-Wagon. If you want to go get one of those, it allows you to accelerate that depreciation and write off most, if not all of that right away in year one. And you don't have to spread it over 5 years. The other thing, retirement accounts are low hanging fruit for tax deductions. So they're pre-tax and post-tax, but most of us have been in W-2 jobs where we have 401ks with match provisions and all of that. When you're a business owner, you can create that for yourself. And they're really, really powerful if you're a solo business owner, or you just have a smaller crew, you're a really lean business. Larger organizations, that gets a little bit hairy. But you can effectively put up to $57,000 in a retirement account. You can then take that a step further using things like defined benefit or cash balance accounts to go from 57 potentially up to a couple $100,000 of a deduction that could go into these different types of retirement accounts. We also talked about the deductions that you take on that now, because you're a business owner, have business use. One that people typically forget about is travel, right? You're the business owner. We talked about being the chief everything officer, right? Chief of marketing, chief of finance, chief of HR, chief of everything. So if you just so happen to like Maui as a destination, and there's an HR conference in Maui, and you need to go there so you can be a better leader for your employees, then go, right? It has a business purpose. Register for the conference. Your travel and lodging and some of the other expenses associated with that trip could potentially be a tax deduction, as long as it's documented appropriately. And by the way, you're in Maui, so there's that too. So, I mean, the list goes on and on. There are so many different things that people could do to plan. One other one that I love to talk about: hiring your kids. That's a great way, especially if you have more than one, to pile up a pretty sizable deduction. Now, documentation and rules still apply, but as long as your kiddo makes less than $12,550, and this is for 2021, so you could pay them $12,550, and they have no federal tax implications, and if done correctly, they have no employment tax implications. So imagine that I get a $12,550 tax deduction, my kid gets that money, and there are no tax implications. What happens if they roll, let's call it $6,000 into a Roth IRA that grows tax-free over time? That's a lot of money that no one's paying taxes on, right? And it's allowed because that's how our current tax code is set up. So all that to say, a number of ways to slice this thing up, and which is why it's important to do some planning.
Yeah, exactly.